Welcome to The Dealist, your insider's guide to navigating the complex world of M&A. In the first episode of Season 3, we heard about the pressures that companies are under specifically from their shareholders to engage with them and to possibly do some action when it comes to corporate governance or things like M&A activity. And to discuss that topic in a little bit more detail, I have today been joined by Michael Vogele, Managing Director in Global Advisory Group at Alliance Advisors, and Charles Elson, a retired Professor of Finance and Edgar S. Willard Chair in Corporate Governance at the University of Delaware. Gentlemen, thank you so much for joining me today. Michael, can I start with you? Can you give our listeners a few words of introduction about yourself?
Yes, and thank you very much for having me be part of this panel. My name is Michael Vogele, and I have been with Alliance Advisors for almost 4 years. Prior to that, I had stints at ISS Corporate Services, their consulting wing, with Glass Lewis, one of the proxy advisors in this space as well. I also had a tour at iVox, which was a European-based proxy advisor, very much primarily focused on European policies and European practices. And prior to that, a little stint at ISS itself. The current stop right now at Alliance Advisors basically helps companies with a whole different set of things from shareholder activism to getting proxy materials together for submissions, for helping with their proxy reviews, helping them with vote no campaigns, helping them with modeling of votes. And very happy to talk about these different things today on this podcast.
Thank you so much. Great. Charles, excuse me. Can you tell our listeners a little bit about how you fit into this conversation and maybe some of the interesting work that you've also done in the sphere of corporate governance and shareholder activism?
Sure. Well, I started out as a lawyer, but then I was a law professor until I retired, and was taught at a number of law schools before landing 20 some odd years ago at the University of Delaware, where I founded the Weinberg Center for Corporate Governance, and held a chair in corporate governance, the Willard Chair, and have sort of been a student of this area for, 40 years or so. Practiced M&A law long ago at Sullivan and Cromwell in New York, before I went into teaching. And so written about it, thought about it. It was kind of there at the beginning of the whole corporate governance movement, and have followed activism and shareholder engagement all the way since. In fact, I was on the advisory board or advisory council of ISS for a number of years long ago, and was quite familiar with the founders of Glass Lewis, ISS, all the other services. But in addition to writing about this stuff and theorizing on this stuff, I've served on a number of corporate boards, public company boards over the years, have been an activist nominee, have been on the other side of a proxy fight, have written a great deal about proxies and proxy activism and frankly, director independence, motivation, done a lot on the audit side, was active in the creation of Sarbanes-Oxley and Dodd-Frank, testified about those two, and I've really been following this area for many, many years, and always had a lot of fun with it. M&A is interesting, fun, and particularly as it relates to the activism business. So I'm delighted to be here with you, and I think we'll have some fun today. I hope.
Absolutely. Lots and lots of fun. Now, I'd like to kick us off by having a look at the landscape in which we're having this conversation. Now, globally, we saw 255 activist campaigns over the course of 2025, so last year, and that has surpassed a record that was last set in 2018. So it's been a long time coming. Michael, when we had a chat just before we came online to record this, you said, I look forward to the days, or I look back to the days when there wasn't much going on, because you are actually incredibly busy at the moment. Give us an insight into what we're seeing sort of globally, but then zero down quite quickly in what we're seeing in the US and why we're seeing these levels of activity at the moment.
I think It's really interesting that, where we are right now because of the changed political landscape with the election of Donald Trump 2 years ago, almost now. There's been a lot of changes within the regulatory aspects. There's been a lot of changes with regards to financial policy. And, that's fed into so many different aspects of the global community. And, within the last month or so, we also had, a repeal of the tariffs. And a lot of the companies are trying just to hold on to understand what kind of fiscal policy they need to follow. And that obviously has a trickle down economic impact for them, for their shareholders, for the stakeholders as well. So you never know what's going to happen, what new regulations are coming out. The SEC has been very active on the United States, and a lot of foreign-based companies are also kind of struggling with trying to keep up with that change landscape. And we're not even talking about the whole global political situation right now, which is also impacting markets, oil prices, et cetera, et cetera. So it's the comment was more like 2 years ago, it was a little bit calmer. The seas, you knew what to expect, but now it could change within a month. It could be changing within a quarter, and our board's ready for that, executive leadership ready for that. And that's, I think, everyone is trying to keep their footing while being, preparing for the next wave.
Okay, thank you very much. Charles, let me bring you in. You obviously have a huge amount of experience, and you've seen sort of the levels of shareholder activism, the levels of engagement from shareholders in the activities of the company fluctuate over the years. How does what we see now feel to you? Is this something where you look back and you say, like, yes, I did see this a couple of years ago, I saw it then, and those were the triggers? Or is this something where you look at what we're experiencing at the moment and say, this is actually a fundamental shift in the level of engagement from shareholders in the corporate activities?
I think it's a shift. I mean, historically, you saw activism primarily at companies that had two problems. A, bad performance. That's where an activist, obviously gets their inroads if people are unhappy. And then secondly, it were governance issues. In other words,
Yeah.
the idea of an activist is, look, I don't trust my board to do the right thing. Why don't I trust my board? Because from a governance standpoint, they're not independent. Let's say they've been there too long. They have too many, ties to the CEO. They're not qualified. And that was sort of the hook. You had bad performance combined with a bad board. And, if you think about it, it's pretty straightforward in that, shareholders elect directors as their agents, or really their fiduciaries. And if you trust their judgment and trust their expertise and their independence, you're going to give them some leeway. Now, when things go south and sour, if they don't have that, the first folks who get blamed are them, well, management and the board. Where it shifted today, it's not so much governance oriented as it is performance or differing views on corporate direction. And that's made a big difference. It's interesting. I think the reason for that is that you have, because of the success of the early activists who came in, made governance changes, brought about better performance, and were very successful at it. I mean, you go back to folks like Ralph Whitworth and David Batchelder, who were kind of early in this game and did very, very well. A lot of other people said, gee, I can do this too. So you saw a ton of new entries. There were some, obviously some more established entries that have been around. But the newer folks, and there are a lot of them, are looking for situations to go into. Now, again, a lot of the situations where they pick up on just had performance that was subpar, or performance that they thought could be increased dramatically in a change in direction. What's been missing in a lot of these recent fights has been sort of the governance issues. The old style board dominated by the CEO who, come hell or high water, my way or the highway. There are not really that many of those around anymore, not many of those stories anymore. Now, that could be changing, by the way, I think, with the rise of the controlling shareholder, as we've seen, and changes in law that give controlling shareholders the ability to pick their boards basically as they like and engage in conduct as they like. I think that will in fact create more activism. Problem in those situations is frankly the activists, because it's a controller, there isn't much they can do. But in the standard company, the amount of real governance issues have really gone down dramatically. So you're seeing a lot of battles really over direction, and that has to do, you trust the directors, and if there's good governance, you can debate it, and typically those aren't that successful for that reason.
But you raise a really interesting point, and I'd like to bring Michael in on this, because the different views on direction. I mean, to a certain degree, to someone like me who's a bit of a layperson to this subject, that sounds like an intensely personal position rather than something that can be necessarily, you look at the balance sheet and say, okay, based on the balance sheet, we need to say X, Y, and Z. How much do personalities and do the people who are actually involved play a role in how much activism we see at the moment, Michael?
So kind of carrying on from what Charles was talking about, that, there has been a pretty big shift back to financials and the performance of a company. A lot of times we're seeing companies that are underperforming against their peers. And I think that that's usually the first hook, is to find those laggards within a certain industry. And, if you look at right now, a lot of the companies within the oil and gas industry are doing fantastically well just because of the spike in the oil price. Now, there are some companies, unfortunately, that are not doing very well, are have the same peers and have the same opportunities, but just are not producing the same return as others. And so those are the ones that I think are the big suspects right now. Is why are they underperforming? Why are they not being able to really manage this boon as well as others? And to your question about personalities and who's on the board, I think that that's where those activists come in there and try and figure out what are the problems at this company, what is inhibiting this growth, and is it an executive problem? Is it is the whole entire C-suite? Is it the senior leadership? Is it the board? Where is the problem with this company? And that's where that hook comes in. And as Charles was also talking about, is it used to be straight on governance. Is there a sufficient independence? Is there any conflicts of interests? What else is going on at this board? And then they start drilling in. And that's when I think the real composition of the board becomes the big talking point. Is there the right skill set? Are the right tenured people in there? Are there people with too much tenure? How has refreshment been going on? And I think that's what we're starting to see bubble up when it comes to this activism. And that's where the hooks usually come into.
Okay. Thank you very much. And we're going to spend some time later on in the podcast talking specifically about the role of the board and how you manage the board. Before we get onto that, I'd like to spend some time talking about shareholder proposals, getting really into the weeds of it. From your experience, Charles, what do you feel is the best way for a corporate to really engage with those proposals when they come in? How can they best manage them? How can they best make sure that they can address them?
Well, I've been through a lot of that over the years, but I've been on boards of companies that have gotten those. And the question is, as a company, you really rather not have that on the proxy, because you're suggesting one thing, someone else suggests something else, and it doesn't make you look good. I think the key is when you get something like this, is to start by engaging with the proponent. What are you really looking for here? And usually, I think if you're open and listen, you can kind of work through it. I mean, there's some things you're not going to work through when it's a proposal that's on a very strong ideological position. That's tougher, because that position may be held by a smaller group of people, and you're, as a representative of the company, you represent a lot of different interests. But on a sort of a governance issue or whatnot, it's reasonable to engage. And once you do, and you can reach sort of a compromise, the proposal will go away, and you'll make those changes. I think to have to slug it out at the ballot box is not a good thing, because if you lose, it's a real vote against not just the proposal, but you as a board or you as a manager. That's the problem with it. If you go back to the history of the whole governance movement, it was the lowly shareholder proposal that got the whole thing going. Because when a company got a governance proposal and it lost badly enough, it was a signal to the activists that, hey, something is wrong here, that you don't have sort of a uniform agreement. And you get around 30-40% on a proposal. It's not that hard for someone to come in, pick up another 10 or 12 and basically change the board. So in other words, the proposal is kind of an early warning, if you will, about problems down the road. And that's why you'd really rather not have them if you can. And if you can't, well, then you make your position known and see what happens. And, and that's then ultimately it'd be up to the shareholders. But I think it's a better world where you can negotiate as opposed to put them on there. Makes for a lot of printing, a lot of confusion.
Absolutely. Michael, talk us through some of the topics that you see coming up in shareholder proposals. Are you seeing sort of a common theme at the moment?
Well, unfortunately, I would say the common theme within shareholder proposals is the absence of environmental and social proposals, because they have not done very well at the ballot box recently. So I think we're going to see those type of proposals become less and less. And those companies that have them on the ballot, they typically are underperforming when it comes to disclosure or having the right principles in place. So I think they'll probably do better than expected, but I don't foresee a lot of them on the ballot box. Similarly, the anti-ESG proposals, I think we're going to see a lot of them kind of dry up as well, just because the case that they're trying to make really wasn't a lot of times based on facts, or things that a lot of the other shareholders wanted. So I think that would be the other big trend that we're going to see, is less and less of those, unless it's a laggard outlier and there's some considerable conflicts there. I think G proposals will continue to be the main drivers of the industry, and we'll see a lot more of. Typically it is the separation of chairman and CEO proposal, or simple majority, or those type of proposals. We'll keep on seeing those, but in the larger instances, I don't think they're going to get a lot of support, unless, again, there are some problems there. I think, though, the bigger overarching theme with all this is with the new SEC guidance on shareholder proposals. And I think that that's probably something that Charles could speak volumes about. So I'm going to let him speak about the legal SEC guidance on shareholder proposals.
Charles, feel free to jump in there.
Yeah, there's, again, I've never feared a shareholder proposal. I've always thought, again, for a board, it's a good thing in the sense that it's a good canary in the mine shaft, so to speak, about what your shareholders are thinking on different issues. The recent SEC chair, Paul Atkins, came in, just a year and a half ago or so, who had been on the SEC for a long time, involved in the SEC for a long time, has demonstrated I think, significant, I guess, hostility to these things. Not necessarily the governance ones, but certainly the environmental, ESG sort of things, the social issues. And he's concerned that they, I think, are really kind of, that the corporate shareholder meeting is not the appropriate place to discuss it. That really, it's really to discuss the company and its activities for the year. And for that reason, I think he's shown demonstrated I guess, hostility, but and really demonstrated a shift in approach. As you recall, he said that this year, those sorts of things, the SEC would not be reviewing them, but basically allowing them on ballots. They weren't going to get involved. The no action process. It was basically, they were never going to take action on it. And he also made a proposal that really this should not be a matter of SEC regulation, but state regulation. That the states themselves, companies incorporated in each various state, that the states had to decide, or state courts should decide what was a viable proposal and not the SEC. And, it's going to be interesting to see how that plays out. He made a pitch to Delaware, with the hope that the Delaware Supreme Court would, get into this thing and say, "Oh yes, our state law says you can't have them, or can't have them, or we'll regulate them." Fortunately, I think at this point Delaware hasn't taken the bait; it leaves it to the feds. A state system, I think, would be rather bizarre. And honestly, in the end, look, proposals that are not dealing with primary corporate issues, but are more secondary or tertiary, honestly, don't add a lot to the mix. However, how do you determine what is secondary or tertiary or primary? And that's why I've always kind of favored a more liberal rule on these things. Let them in, let them vote. They're not that expensive. It's, let's say an extra, you have to solicit, obviously, and you got an extra bit of printing on the proxy. But I've never been as worried about it, because I think anytime you try to limit these things, you'll throw out the baby with the bathwater. The really important ones are the governance ones. Those really have made a difference, or fundamental corporate issues. And that's where you just don't see a lot of those these days. We've been really crowded with environmental and, social resolutions. And I think they've given the resolution business kind of a bad name. So again, Paul, I think, is trying to limit those. But in doing so, I'm a little concerned that the really important ones will go too, because every shareholder, you buy a share of stock, has the right to voice their opinion. That's part of owning a share of stock. And you're really squelching speech is just never a good thing, because you don't know where good speech is going to come from. It can come from a large shareholder. It can come from a very small shareholder. And that's the problem with, I think, attempting to limit this. The more you limit it, the more reasonable ideas don't get expressed. And the more, of course, the more you broaden it, it creates a lot of clutter. It's like the internet. There's just a lot of stuff on there. And how do you separate it out? But in the shareholder business, I've always kind of favored a more liberal rule than not. So because I think it's a tough one to sort out. And I'd rather include more that isn't as important, rather than limiting it and running the risk of getting rid of things that really are important to boards and to the corporation.
Cool. Thank you very much. We're going to take a quick break there. And when we come back, we're going to talk about shareholder activism and M&A.
Data drives deals today. Cut through the noise and get to what matters with Deal Center AI, powered by Link, your AI assistant. Turn raw deal data into meaningful insight, and insight into real competitive advantage. See more opportunities, close more deals, stay secure. Transform your deal making with Deal Center AI.
Thanks for joining us again. We are going to spend some time talking about M&A and shareholder activism. In one of the earlier episodes in the season, we heard that companies, their boards, are preparing for potential shareholder activism on their books by doing a really, really active portfolio review, looking at the company with the eyes from an external party, potentially a shareholder activist, and seeing what could potentially come up for criticism. Michael, can I bring you into the conversation and just ask you about what your experience in that field is? How new is that development really, or is that something that's been going on in the background for many, many years anyway?
I would have to say that for those companies that are really proactive and trying to really manage the company in a very effective and efficient way, I think they've been doing this quite frequently anyhow.
Yeah.
I think they do a gap analysis, trying to figure out where their weaknesses are. Soliciting conversations from their largest shareholders on an annual or every second year kind of conversational piece, trying to see what their concerns are, just to really figure out if there are weaknesses, and trying to avoid those kind of unfavorable conversations, because anytime there's an M&A or a hostile bid or activism, it makes you kind of lose focus on where the ball is going.
Yeah.
So I think good companies already doing this. I think it's more that it's becoming more mainstream, and a lot of other boards are trying to get into this space as well.
Okay, thank you very much. Charles, do you think there is ever any opportunity or possibility of stopping an activist shareholder in their tracks by some activity that the corporate engages in? Or is it something that once they're on your books, once they've got the bit between the teeth, so to speak, there's no stopping them?
I think it's sadly kind of that. I mean, look, I mean, I think once an investor has a thesis or a theory, they're going to push it all the way until you adopt that. The problem though with it is, a theory is just that, and I've
Yeah.
seen that theory sometimes blow up. It doesn't turn out the way they think. Again, that's why you have a board, and that's why you have to sometimes trust your board in these situations. An independent board that has a lot of equity in the company itself, and has the right experience, is probably thinking about it the same way you are. I mean, I've seen that situation many times where a board itself has been considering exactly what the activist has been proposing. Then the activist shows up, bangs their fist on the table, and the company reacts. And the theory is, oh, well, they would never have done it had I not shown up. Not necessarily the case. But that's the problem of the crowded space. The more people in this business, the more people are seeking to make money as activists, the more less than legitimate complaints will come to light. But once you're in there, if you suddenly say, okay, thanks, goodbye, and go away, that doesn't help your reputation, if you will, down the road with other activist situations. You've got to be able, I think, to show the world, look, I'm the tough person, and here's what I accomplished. And if I'm come to you, I'm never going away, until you do what I say. And that's it. Yeah, it's built. I think what's going to happen is a lot of these funds won't be as successful as they thought they would be. And at some point, they'll wind down and they'll find some other niche to jump into, and hopefully leaving a reasonable amount of folks in the activist sphere. But again, too many players and not enough good situations means that some less than legitimate situations will appear, and that's a real problem for a board, because having an activist in your stock that I think is being unreasonable really makes your life, not only your life miserable, it makes management's lives miserable too. And the problem with that is the distraction that the management will have to deal with, and you'll have to deal with, takes your eye away from the ball, so to speak. And the more you have to deal with back and forth with an activist and arguing over a point that probably is a judgment point and really can be argued effectively either way, detracts you from running the business. And if you can't run the business and you're busy worried about an activist campaign and responding to attack letters and things like that, it's hard to get your job done. And that's the dark side of activism. And that's something I've always been a pro-activist. I think it keeps companies on their toes, keeps boards on their toes. But there is a limit to it, and it would become sort of a self-propagating or self-promoting action on the part of the activist. It really harms the company and the other shareholders in the end. Your job is not just to them. Listen, they own 8% of the company, let's say. You got 92% who might not agree with them. 8% can't run the show, and that's the problem. I think the downside of ACT, and I've written about this. I'm the executive editor at large at Directors and Boards, and I do a column, and I've written about this a couple of times. having been in the middle of some of these things, to my displeasure sometimes. But that's what you do.
But it's interesting what you say there about this distracts from the actual operation of the business, because those are some of the comments that we had in our episode looking at IPOs and how preparing a company for an IPO can be a massive distraction for the management team from the actual running of the company. The same as an M&A process can be a huge distraction from the actual running. And I think that's something that while we're zeroing in on these topics, whether it's M&A, whether it's IPOs, or whether it's shareholder activism, fundamentally, we're talking about a company that needs to be run. And for it to be run successfully, we need the managers to be focusing on that and not dealing with loads of other things. Sidebar there. Sorry, excuse me for putting that in there. Now, I'd like to move on and spend some time talking about the board specifically, because we've spent some time throughout the podcast talking about it. And when we did the prep work, Michael, we spent a fair bit of time talking about the challenges there are due to there not being any limits on how long a board member can stay on the board. Talk me through how much of a problem you see that. How much of a problem is it really that in the US we don't have these term limits versus other jurisdictions where we do have very, very clear term limits? And then also some of the strategies that companies employ to make sure that they still get what they need out of their board, particularly when it comes to the independence.
One thing I want to say before we get it, I want to clarify that statement is I don't think there is a problem with having one or two board members who have a longer tenure. And by longer tenure, for me, that's anywhere above 12 years,
Okay.
Which is that is where I think a lot of, especially European investors, think that is the point when a director becomes non-independent because they've just been there for a long time.
Yeah.
I think having that long tenure is really good because it kind of helps calm the board. It shows that, they've probably gone through the ups and downs within that organization, the booms and the busts, and they can, kind of help the other newer board members on how to navigate them. The problem becomes when a majority of your board has been there too long, and you're not bringing in fresher voices, and voices who might have had different experiences when it comes to technology, might have cyber experience, AI experience, have different kind of skill sets to bring to it. So I think that is the bigger thing, is if there's not the right refreshment of, maybe getting one third of, some newer board members, some have been there somewhat longer tenured, and then, obviously the older guard. Unfortunately, and this is something that we see all too often, is in these, proxy fights, in these activist situations, the board members who end up being targeted are these longer tenured board members. And it's almost as if that skill set that they bring is no longer seen valid. And I think that's probably the biggest unfortunate circumstance here. But a lot of the times, those board members don't have the skills anymore. That is part of where the company is going. So it's a very weird dynamic when you're talking about tenure. Is like, are they still contributing? Yes or no? And I think one way that a board can do a really good job of trying to assess that is, have those board evaluations done annually internally, and then every 3 years, 4 years, have it done externally, and really suss out if you still are fit for purpose on your board, if you still have those right board members, and then, sometimes make that hard decision of letting that elder tenured board member go.
What do you think are the skills that most companies need? I mean, obviously there's skills that will be really specific to the company depending on what kind of company is it. But are there some broader skills where you say, well, these are things that really we want to see on the board to get a sense of confidence and be comfortable with who we have represented there?
I don't think there's one answer to that. I really think, like you said, it is really market and industry specific. And thereby it's really hard to lump that all together. But I would say having a very diverse board with different skill sets is, I think, the way to go. We've seen so many board skills matrices the last few years, and they're becoming commonplace, which is great. But sometimes you see that every single board member has the same skill over and over and over again. And the question becomes, are you looking for the right people on your board, or are board members just saying, yeah, I've got that skill, let me tick that box, and thereby you're not really answering what is needed. So I think doing a really thorough, honest audit of what the skills are, and then kind of bring them into the corporate purpose, the strategy of the company. Are you aligned there? Are you supplementing, the skills on the executive leadership team? So it's much more communicative. So you can be that body that is reviewing the executive team's function, and making sure that all the right boxes are ticked to make sure the company is being driven for the long term.
Okay, thank you very much. Now, Charles, let me bring you into the conversation. Now, anyone that Googles your name very quickly finds articles about an argument that you had with a shareholder in relation to the board and how he was being dealt with. I hope you don't mind me putting you on the spot a little bit. Can you tell us a little bit about the Elon Musk situation, if you can, and sort of where you see the problem there in relation to the board, and where maybe the board isn't quite doing what it was supposed to be doing?
Yeah, well, it was an interesting, he was one of those quote unquote controlling shareholders I was talking about earlier. He has effectively control over that company and its board for a lot of reasons. And the difficulty there in that space with someone like that, the board isn't monitoring as it should. There's basically no way that board can ever terminate him. That's that's the fact of it. And so then the question is, if you can't fire the person you're monitoring, what's the point of monitoring? I guess you give him some advice, but he doesn't seem like someone who easily takes other people's advice. And so the problem for a shareholder is your board basically in that situation is kind of neutered. It's not only that he decides basically who runs and who doesn't run, but the compensation of that board has been so astronomical. It make it very difficult for them to be independent of him and exercise any dissent, if you will, from him. I think it was estimated that the total take of the independent directors was somewhere like $2-3 billion. This was a Reuters story, I believe. And that's incredible. I mean, the chair of the board, at this point, value maybe has walked off at some point or has $750 million and something like that in astronaut. And how in the world for a job that you meet 4 or 5 times a year and there's legally very little they can do with D&O and whatnot, can you compensate people at that level? There's very any rational human being would find it very hard to say, $700 million and say little, or say something and lose it all. I don't. And that's what the judge found, obviously, in the Tesla case. And that's a real problem because boards at that point really are parsley on the corporate fish. I mean, they're green, they look okay, but you don't want to eat them. There's nothing there. And the shareholders elect directors to basically monitor management. And when they don't, that's when you run into problems. The question is, what can you do about it? And in the case of Tesla, nothing at this point. They've left Delaware, they've moved to Texas, where it's almost impossible to bring a derivative action by a shareholder. They can effectively do what they want to do. And that's a real problem for investors because as long as it's going right, hey, terrific, leave it well enough alone. But the board is a circuit breaker. When something goes haywire, that's when they step in and say, hey, we got to shift. Listen, any company that has a CEO that disappears for 6-8 months and goes to work for the government and isn't at the company, it's a little strange. Or makes statements that, really have created real problems, sales problems for the company vis-a-vis perception, or has all these other businesses that they seem to be focused on, or threaten to walk unless the company does X, Y, Z for them in another business they're involved in. You would never survive in another company like that. But he gets a lot of leeway because he's the genius. But sometimes geniuses make mistakes too. And that's where you need a good board. And that's the issue, I think, with Tesla or similar companies. Boards are shareholders' best friends. And directors' best friends are the shareholders, not the managers. I think you have to look at it that way.
But I think it's fair to say that the situation that we have at Tesla, that is a unique situation and definitely not the rule, that it is the exception rather than the rule. Is that correct?
Well, yes and no. The more successful he is at basically running that board, the more others who view themselves as geniuses will do the same thing. You've begun to see those sort of supersized, weird comp packages appearing at other companies, which is very, very depressing. I mean, there are a lot of people out there who feel that they don't have modesty about their abilities. And so when you have that happen, this is sort of the environment, and they can point out and say, well, he gets it, it's okay by him. That's the problem. When you start making exceptions, they eventually become the rule.
Yeah.
And that's, I think, what the judge in Delaware was trying to say in that compensation case, that it isn't just you, it has impact on others too. I think that's what message she was trying to send. Obviously, Supreme Court overruled, upheld her findings, but awarded him, a company, $1 in damages, which has defeated the whole point of the whole thing, which I think makes you'll probably see more of this, which is really too bad. Really too bad.
Yep. Great. Thank you very much for sharing a little bit of insight into some of the work that you've recently done. Now, to wrap things up, I'd like to ask each of you to share some advice with us that you would give any corporate that looks in its shareholder register and discovers there is an activist in there, maybe an activist that hasn't really said anything so far, but obviously the feeling is something might be coming down the line there. Michael, what is the piece of advice or the pieces of advice that you would like them to consider?
I would say the number one thing is to have a really good stock surveillance program to see who's in your register, what they're doing, who else is coming in there. Because, usually it's not just one activist that's in there, there's multiples. So that would be the first thing, is keep a really good eye on your register. Second of all, I would, one of the things that I think a lot of companies miss is how crucial, how vital your investor relations team is to this whole ecosystem.
Yeah.
So really communicate with them, get in touch with them, lean on them. They have those quarterly calls with, the big houses. They know what the concerns are. They know what they're asking about. So leverage that information gathering there. So it's, rather than siloed off, but a conversation together. And then from your IRO team and your corporate secretary team, start a engagement outreach to the stewardship teams, to the governance teams of your largest investors. See what they are seeing from the other's perspective. So less from the financial side and more of the qualitative side. Excuse me. So that would be my first three things to do. And then, after you've gathered information in those sources, do a gap analysis and seeing where are you maybe vulnerable.
Yeah.
And once you've done that, that autopsy, start communicating changes as quickly as you can. So you are ahead of that activist. You're the one who's driving the narrative rather than the activist saying, oh, this was us. Because a lot of times those activists try and, puff themselves up as being really the drivers of changes, when a lot of times it is the companies doing the hard work. They're doing their due diligence. They just don't get the right credit because they're not disclosing properly.
Fantastic. Some really, really useful pieces of advice there. Thank you so much, Michael. Charles, what would you like to add?
I agree a lot with Michael. I think the key is checking your base and saying if you're migrating away. Your shareholders tell you a lot about how your company is viewed. If you move to the value folks or from the value folks to the established long-term institutions, that's the story that you've stabilized. If you suddenly begin to see activist funds appearing on the register to the decrease of your long-termers, that sign something may be up. I think the key is, number one, is engagement. You got to talk to these people, listen to them, give them their chance to speak. Nothing is worse than trying to say something and having someone shut you out. It's disrespectful to the other person, and it doesn't engender a lot of goodwill. So sit down and listen to them. I think you don't have to do it at the moment, but listen and engage and understand what they're seeking. If you agree with it, then you start to make the changes, or maybe you already have thought about it and have convinced them of that. If, on the other hand, it's a question of direction, and you firmly believe your direction is creates better long-term value, and even short-term value, if you think about it, because all short-term value is the notion that you've got going to have long-term value, that if it comes to it and you have to have a fight with them, then so be it. That's where your long-term shareholders come into play. The large funds, the Vanguards, the State Streets, the BlackRocks, go down the list. They ultimately, if you can make a good argument, and I think you have decent governance, are probably your best friends, because they're not there for the short term. Let's wait for let's take a year and take some money and exit. They're there because a lot of them are indexed, obviously, and they're going to be with you for a long, long time, as long as you stay in the index, I guess. And they ultimately will decide these contests. And that's where that's really important. And engagement with them on a regular basis, the governance folks at the large institutions, I think is helpful, because look, the issue is, do they trust the board? And if the answer is no, they're going to go with the activist. If the answer is yes, they'll stick with the board, because the board does have more information and has closer to the situation than an outsider. An outsider may have great ideas, and that's why a board has to listen. On the other hand, the outsider doesn't have the nuance, because they're not there all the time. And sometimes their theories are interesting, sometimes they're not so interesting. And that's why I think that you have to listen, respond effectively, and if necessary, don't be afraid to take it to a fight in the end. In the end, maybe you take a candidate of theirs on. I've always thought the best thing to do is take a compromise candidate, find someone that you both can agree on, and maybe that settles the thing and you move forward. But I don't think you can give in simply because one appears. Engage, discuss, try to compromise. If you can't, then you're going to have to go to the large institutions and make your case. And usually, we'll see what happens from there.
Brilliant. Charles and Michael, thank you so much for sharing all your insights. Unfortunately, that is all that we have time for on today's episode of The Dealist. But I really appreciate you guys coming on board and talking to me about this incredibly interesting topic.
Thank you very much. It was fun being with you.
Great.
Thank you for having me.
Now, if you enjoyed this episode of The Dealist, please like, follow, and subscribe, or comment. We'd love to hear from you. This is all for season 3 of The Dealist, but if you'd like us to pick up a topic or indeed have an interesting M&A deal-making story to share with us, please get in touch. The details are at the bottom of the screen right now. Thank you very much for listening. Until next time, goodbye.